Have you ever felt that knot in your stomach when you see the market start to drop? We all have. Today, we're going to unravel that feeling and replace it with a clear, calm strategy. Yeah, that's the question that can fill any investor with dread, right? But what if I told you that drop wasn't a threat? What if it was actually an opportunity? We are going to show you exactly how to turn that fear into some serious confidence. All right, so here's our game plan. We'll start by tackling the panic problem itself and, what's actually happening in our brains during all this chaos. Then we'll look at the real cost of that panic. After that, we're diving into the masterclass playbook from the one and only Warren Buffett. And finally, we'll put together your own personal volatility survival kit. Okay, first up, let's just get on the same page. What are we really talking about when we use that word volatile? So, in simple terms, volatility is just a measure of how much market prices are swinging around. You can kind of think of it like the market's mood. Some days it's calm and steady, and other days it's just all over the place. Now check this out, because this is fascinating. This chart shows that on the absolute worst days for the market, yeah, the S&P 500 drops, no surprise there. But look at the VIX, that's the fear index. It doesn't just go up a little, it explodes, it skyrockets. This is a massive overreaction, and it's driven by fear, right when we are at our most vulnerable to making bad decisions. So if the market's reaction is basically supercharged with fear, you have to ask, where does all that fear come from? Well, it turns out the real battle isn't with the stock market. It's actually inside our own heads. You see, our brains are literally hardwired with these mental shortcuts. We call them biases. And look, they help us make quick decisions every day. But when we're under financial stress, they can push us to make some really irrational and frankly costly choices. Let's look at the three biggest culprits. Okay, first up is a big one, loss aversion. Psychologically, the pain of losing $100 feels about twice as bad as the pleasure you get from gaining $100. It's wild, right? This is exactly why a market dip feels so terrifying, and it's what makes us want to hit the sell button just to make the pain stop. And then you've got the herd mentality. When it looks like everyone around you is panicking and selling, it feels safer to just follow the crowd, right? But the thing is, in investing, the crowd is very often running straight off a cliff. They're selling at the absolute worst possible time. And to top it all off, there's confirmation bias. This one acts like a filter on your brain. When you start to feel scared, you suddenly only see the scary headlines. You're actively looking for news that justifies your fear, and you completely ignore any data that might suggest, staying calm. So we've got all these biases messing with our heads, but what's the actual real-world financial damage of letting them take the driver's seat? Well, it's not small. Giving into panic isn't just a tiny mistake. The research shows that the average investor loses somewhere between 8 and 15% of their total wealth over a decade simply because of emotional decisions. Just let that sink in. It's a massive self-inflicted wound to your financial future. This quote just puts it perfectly. The problem isn't your stocks or your funds. It's that very human impulse to react emotionally. The investments themselves are just doing what they do. The real challenge is managing our own behavior. But what if we could just flip the script? What if we could learn to see all this volatility not as a threat, but as an opportunity? Let's take a look at how a master does it. This is the absolute core of Warren Buffett's philosophy. He literally sees market panic as a giant everything-must-go sale on fantastic companies. While everyone else is running for the exits, he is calmly reaching for his checkbook. And his playbook? It's actually shockingly simple. He just stays calm. He focuses on the quality of the businesses he owns, not their stock price on any given day. And, this is crucial, he always keeps cash ready to go. He's not trying to perfectly time the bottom. He's just buying great stuff when it's on sale. This just gets to the heart of it all, doesn't it? Patience isn't just a nice little virtue in investing. It is the very engine that transfers wealth from the emotional and the frantic to the disciplined and the patient. The market simply rewards those who can sit tight. So how do we become one of those patient ones? Let's actually build your personal volatility survival kit right now, so you're totally prepared to act rationally when that pressure cranks up. It all really comes down to three essential pillars. First, you diversify your portfolio so that no single event can completely sink your ship. Second, you have a written plan. This is your rational guide when your emotions are screaming at you. And third, you pay down high-interest debt to build a kind of financial fortress around yourself. This is the journey every successful investor has to take. You move away from making those emotional, reactive mistakes and toward making smart, systematic moves. Instead of guessing, you use a disciplined system. Instead of concentrating all your risk in a few bets, you diversify it. And that written plan, seriously, don't skip this part. That simple act of writing down your goals is like a commitment device. It's an anchor in a financial storm. When you feel that urge to panic, you can pull it out and look at the plan you made when you were calm and rational. Because ultimately, you get to choose. By seeing volatility not as something to fear, but as a natural part of the process, and even an opportunity, you can prepare yourself not just to survive the next downturn, but to actually thrive because of it. The key is having the right mindset and the right plan in place, long before the storm ever arrives.